Let's turn back to the major indexes. Joining me now is Doug Flynn, certified financial planner and co-founder of Flynn Zito Capital. Doug, thanks so much for coming on the show. What do you make
Hi, Kristen. How you doing?
I'm good. What do you make of today's market action with the NASDAQ actually eking out a gain of 0.1% after having been down worse than 2% earlier in the session?
Yeah, that's surprising. I didn't think we would get that bounce off the bottom like we did, to be honest with you. It's we've been running a couple of days in a row, like 4 days in a row now for both the S&P and the NASDAQ. And the S&P closed down for the 5th day in a row, but the NASDAQ did eke out a small gain. So it's good to see it bounce off the lows. You know, doing this a long time, you see the market actually at times never quite hit that full 10% to give you that correction. It does that repeatedly. It'll go down 9 point something percent. There's a lot of pent up demand waiting for that official 10% to come in, and then it doesn't happen. So all those people that were waiting for the full 10% didn't get it today.
I think that is a really good note. We know that there are still trillions of dollars on the sidelines, but Doug, rates expected to go higher from here when the Fed does meet several times this year, and that 10-year Treasury yield hitting 1.8% earlier in the session. The fact that we didn't quite get a correction, a loss of 10% from the NASDAQ's recent high, does that signal that we're out of the woods, that those buyers will continue to come in, or does this still create an uncertain environment for 2022?
I think the volatility is actually good and welcome. And, you know, the biggest issue always, and not just with the NASDAQ, but also with the S&P, you know, the top 10%, top 10 holdings in the S&P 500, the price to earnings ratio on those 10 stocks, 8 of which are tech companies, is 60% higher than the other 490. So what happens is all those stocks that we know and love that everybody flocked to during the pandemic and drove up might also suffer a little bit as we emerge from the pandemic and people go back to the things they might have done beforehand. You can't have it both ways. You can't have all these tech companies benefit from everybody staying at home to also benefiting in the same exact manner 100% as people come back out of their houses and do more. So maybe they hang on to a good chunk of it, but not all of it. So therein lies some opportunity and some volatility, and that's what you're looking for. You're looking to pick your spots on when you're going to add to some positions that you used to like at that price, but now you really like at this lower price.
Interesting. And now, of course, we have some major catalysts that could move the markets this week. Fed Chair Jerome Powell testifying at his confirmation hearing tomorrow. Inflation data for consumers on Wednesday, for producers on Thursday, and then big bank earnings from JP Morgan, Citigroup, and Wells Fargo on Friday. Positive comments that we heard from Jamie Dimon earlier today, we should say, Doug, on another network. Will this be a buy the news event after we've sold off certainly today, but we recovered into the end and we've got these key events ahead of us? Do you see this as a buy the news sort of week?
Absolutely. You know, it's interesting. If everybody has baked in maybe 4 Fed rate hikes this year, maybe we get 3. The problem with interest rates going up is that directly impacts the cost of borrowing, which tech companies use to expand their growth. So that can put some downward pressure on them if rates go up a lot. Now, if it looks like maybe the Fed won't act as quickly or as efficiently as it should or everybody's expecting, and maybe we get less Fed rate hikes for whatever reason, there are pros and cons to that. But one of the pros might be that maybe there's some more room there and some more opportunity along with those same companies that we've been chasing for all this time. So, you know, that could be exactly how it plays out, but it remains to be seen. Some of those words will come out tomorrow, and then we'll see how it actually plays out. I tend to be in the camp that the Fed waits too long. In the short run, that's nerve-wracking when they do raise rates, but in the long run for the economy, look, short term could be negative to the market, but long term for the overall economy is very good. We have to keep inflation down, and that means raising rates. And so maybe they do it only 2 times instead of 3 or 4.
Interesting. Now, there is, of course, that famous saying in the stock market that as goes the first 5 days of January, so goes the year. Well, we officially did actually decline the first 5 trading days of this year, Doug. Does that portend where we might end the year?
You know, that you could do the first 5 days, you could do as January goes. There's a lot of those adages, and they don't always come true, but it does give you an indication of where people are thinking. Look, you know, last year we only had the maximum downturn was like 5%. We didn't even have a correction last year. And so, you know, I keep saying it, and it's painful when we go through it, but we need that. We need to shake some people out of the market, shake some investment out of the market, put some of that cash to work for other people that have been waiting for that opportunity. And corrections are good as long as they don't turn into a recession, which is not on the horizon. Although, admittedly, if we keep inflation very high, and that's going to be really the next thing that we have to see, is inflation going to stay as high as it was, or is it going to mute a little bit? That's really the big trigger that we're all looking for to really get some clear direction on how the market goes. So we can think January is going to be it, and then we can get a curveball based on what happens with interest rates and the market there. Okay, so even though investors bought the dip today, certainly the NASDAQ and some of the semiconductor stocks, some of these riskier assets, Doug, that had been down 2-3% at certain times during today's session, earlier in the session, is that where you see the opportunity in 2022? They got a deal, but do those stocks continue to outperform this year, or are you looking elsewhere for greater growth? It's a good question. When the market is stretched as it is on the growth side, and we saw a little bit of this start to peep out a little last year on the value side. Look, year to date, the best sectors so far are energy and financials, not tech. That's where we are right now. Now, I don't know if that continues, but there is opportunity on the value side. You can't have one thing go and go and go into infinity. I was here during the late 90s into early 2000, as some other people were, and they've seen that movie before where we thought tech stocks will go to infinity. And we all know that they do not. There will be some winners. There'll be some continuance of good companies, and a lot of them are good, but there's going to be some shakeout and some better growth opportunities elsewhere. I'm not saying sell. You don't want to sell. But if you're already 70% tech, as one of my clients today asked me, should we add to this area of my portfolio? And we examined it and we said, you're already 70% technology right now. I don't think what we need right now is another tech company, as good as it may be. We need to look at some other opportunities. You don't want to get in that situation. Maybe people haven't really looked into what they have. If they have all crypto and all tech, there's some other opportunities out there for sure. I think that's a good point, right? Obviously, looking at your own risk tolerance and the makeup of your current portfolio. But Doug, we had heard, certainly bank stocks, energy stocks expected broadly from strategists to continue to do well this year, perhaps even outperform. Of course, we know banks, for instance, would make money, some of these financial centers, on a more volatile stock market, as well as a steeper yield curve, higher interest rates, because they can make more money on the money that they lend out. Banks, energy stocks, are those some of the more attractive sectors to you this year that you think might outperform? They can, and definitely exactly for the reasons you just said. But if you don't want to be hyper specific into those sectors, and you have a lot of growth in your portfolio, you can use more broad-based, value-oriented stock and ETFs and the like. You don't have to pick individual sectors. If you don't want to bet into those particular areas, you can do a more broad-based value portfolio. But you want to be a little bit more balanced than maybe you had been in the last couple of years, and not abandon what you've done, but just thinking about next dollar, is that the best place? And some of those other areas absolutely are in the value side of the equation. And cyclicals are another area in an emerging economy. As everybody gets back out there and starts to spend all of this money that they've stockpiled, perhaps that will also be another area that people should definitely look to. How much money, Doug, do you see on the sidelines that could benefit this economy, that could benefit the industrials, and thus could benefit the stock market? Are we still talking trillions of dollars that have been saved by households during this pandemic? You are. In fact, you're looking at the individual consumer in probably the best cash position they've been in a long time, the best debt to income position that they've been in a long time. And so they've paid down debt. They've gotten themselves in a pretty good situation. Not everybody, obviously, but across the board, overall, how you measure things, that is the case. That is going to make its way into the market as there's opportunities. So, that's what I'm looking for is to try to pick your points, find some, again, we keep waiting for this 10% correction. Maybe we hit 9.8 a couple of times. So maybe we lower our entry point to just below 10% to try to take advantage of some of that, as evidenced by today. Mm-hmm. But I do think you get one of those corrections this year, and that's an opportunity. And maybe you have some things that you've wanted to buy and you look for the price points to go in there. But I do see that cash coming in more and more and more. People tend to chase a couple years into something after it's already ran its way up. That's when they like to buy. But of course, we know that that's not the best time to buy. It's when things are on sale a little bit, when you're buying good companies. Yeah.
So, well, we know rates are still clearly right near zero. They're expected to creep up slowly. I don't think that they'll end officially in this tightening process where they might rise through this year, but continue to rise in the years after this. So, Doug, I know you mentioned, obviously, if you see stocks and sectors on sale, it's a good time to get in. But how do we end the year? I mean, do you think that the stock market can still, after a double-digit gain last year, continue to collectively rise once we get to the end of December of 2022?
I do. I think, interestingly, the market's average return is somewhere between 10 and 12% per year on average if you go back 50, 60, 70 years. And interestingly, in the last 50 years, I think it's only finished within that actual average time frame a handful of times. Most of the time, it's either way above that or below it, and it averages that out over time, which is what we come to. I think you could end up with a more average year in the market, which would still be an excellent year overall, but maybe not the outsized returns we've had the last couple of years. But I don't see, unless the Fed completely, over tightens or does something drastic, or there's always that wild card of something that we can't, imagine, that we don't know that's built in, some kind of a, somebody invading another country, all these things that can happen in the short run. I don't think that takes away from the long term right now. Things are still looking good. Look, interest rates are going higher, but they're still low. So maybe they're less low, but they're still low by historical standards. Once you get above 3.5% to 4%, then you start to see some inverse correlations in the market. But until then, you really don't. And so I think the wind is maybe a little less at our back, but it's still there.
Doug, is cryptocurrency attractive to you? Is that something that you're recommending for your customers, your investors? Are they finding that attractive? And with a pullback today, and certainly a pullback in 2022, is this a good entry point for cryptocurrency?
That's an excellent question. So when crypto really started to come out, we wondered, hey, is this truly an alternative currency, a hedge against inflation? And, in November, when interest rates started to go, and when that inflation report came out, everybody flocked to those types of investments, including gold. Since that high in November, crypto's down 40%. And gold is down 4%. So what happened was we thought it was going to be more like an inflation hedge, but it's acting more like a risk asset. And so when people are selling, the big benefit to crypto is it's very liquid. The big negative to crypto is that it's very liquid. You can sell it easily. So it often gets sold right off the bat because you can sell it. And that's a lot of the downward pressure. So if it turns out that it is an alternative currency, it is a hedge against inflation, acts more like that alternate currency, then I like it from that perspective, decentralized government. If it's going to be another just risky asset that people are going to play like that, and it's not going to give you those benefits, then it's just a trade like anything else. And I don't see, whether it's gold or whether it's crypto, if it doesn't have earnings, if it doesn't have profits, if it doesn't sell things to other people, it's a trade. It's not an investment. It's a hedge. It's those other things. So that really, I think the book is still out on that. There's two camps. We don't really know which one this is going to actually turn out to be. And until then, there lies some of the opportunity. But 40% off is better than it was. There were people buying it well into the 60,000 plus range. Right. Below 40 and 30, I think, of course, is a much better price point.
All right, Doug Flynn, certified financial planner and co-founder of Flynn Zito Capital. Doug, we appreciate you coming on the show.